What's going on? I hope everybody's having a great day. Welcome to my channel. I am the covered call guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income. I am currently holding 6 cover call ETFs, and if you want to know what I'm holding, stay till the end of the month. At the end of every month, typically the last 2-3 days, I'll show my portfolio review, holdings, portfolio size, what I bought, what I'm holding, or if I didn't buy anything, didn't sell anything, I'm just holding cash. I'll let you guys know. So stay tuned for that. Legal disclaimer before we start. Oh, wait. Annual dividend income is about $70,000 a year, 5.8K a month, 1.3K a week, $191 a day, $7.99 per hour. Estimated, projected. All right, legal disclaimer before we start. This content's for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I'm just some random idiot you found on YouTube, and I could be completely wrong. All right, let's get started on today's video. I made a post about this. Remember, I asked for boosters idea, and I made another video on this, and it just seems like this is quite popular for a lot of people that are trying to rotate into NEOS for boosters, and they're kind of selling off their high yield other high yields into this. So I just want to make a video on this. I know a lot of people commented, especially Chippy is very popular, but I'll make another video on that. But let's talk about the NEOS boosters and if it fits into my portfolio, right? So this is my portfolio, and it fits in my portfolio and my scenario for my long-term hold. All right, so the turbo yield boosters, I'm gonna be asking myself, is NEOS XSPI and XQQI the holy grail of boosted monthly income or a leveraged death trap? Let's dive in. Again, I'm speaking for my portfolio and my long-term hold horizon. Okay. And of course, continue to help me out. I do need some new boosters. Obviously, not in 2026. I will be focusing on readjusting and kind of fixing up my portfolio for 2026. But again, I'm gonna give it some time. I'm okay. I'm gonna be on the sideline waiting a whole year, a year and a half for these boosters. So I'll put them on my watch list, unless of course good deals come along and the market really takes a big major hit. Then I'll go ahead and of course buy the dip, buy the low, because the market always goes up, right? So if it comes to time that is really discounted, I'm gonna buy. All right, so why am I looking for turbo boosters? Simple, right? I'm looking to add some serious horsepower to my portfolio. Simply put, boosters are exactly that, right? Boosting my yield, right? They're designed to turbocharge my monthly income, while the more traditional cover call ETFs play it safe, right? The NEOS XSPI and XQQI kind of strap a little turbo mini rocket to my portfolio with a 1.5x structural leverage and active call valet. But the real question is, right, are they the holy grail of income or a leveraged death trap for me, right? I want massive yield, but I want to supercharge my current portfolio, but I don't want to do it at the cost of, oh my god, it's already been 6 months holding this, I gotta sell and just cut the losses, right? So that's not what I want to do. All right, let's look at the holy grail features, right? So it's a high octane yield, right? So my maiden dividends in February 2026 projected immediate 20% plus annual yields, right? Writing calls on a notional base of 1.5x. My physical holdings multiplies premium collections. Physical plus synthetics, right? So I hold the actual stock and collect corporate dividends. Then the synthetic long achieves the 1.5 leverage exposure, right? Without traditional margin debt or interest rate drag. And the third is the smart options laddering. So I think they're using a dynamically adjusted strike based on the IV, the VIX, right? Laddered expirations smooth out my premium extraction, mitigating timing risks, right? So the allure of this is, of course, the turbocharging my yield without paying a massive margin borrowing rates, because then of course they have to make more, and then the expense ratio, and then of course no profits mean it eats away at the NAV, right? So the turbocharge tax loopholes. So again, they still use the section 1256 contract, so it's great, love it, very tax efficient. And then return of capital, right? Distributed act as return of capital, ROC, right? So this defers my immediate tax burdens and just reduces my cost basis, right? So pretty good for converting income to future long-term gains. However, the good with the bad, right? I'm gonna say the bad is the death trap door. and this is the first one, right? The exhaustion. Rock, you have to really understand that it is mathematically finite unless you do have a game plan with your tax accountant. But for the most part, for the most generalized income, investor population is finite, right? So what that means is once your cost basis hits zero, future distributions become immediately taxable, right? So you got to plan ahead on this, right? The benefit overall, you keep more cash away from the IRS, but only for a limited time. Again, I made a video on this, and if you need another video, updated strategies, let me know. All right, so building the turbo engines, how they do it with 150% exposure, right? So I think it's broken down into these 3 steps. Of course, one is to hold the index. First, they hold the index of 100% physical basket of the actual underlying stock. 2, they add a synthetic long, right? So this is how they get that extra 50%, right? So they buy at the money and a little bit of out the money calls and then sell a put on it. And then boom, extra exposure right there. Third is this, they sell the options, right? You got to get the premiums. That's how you get paid, right? So you write the options on that massive 100%, 150% base to pay out the huge yields, right? So the mechanics behind all of this, it is a structural synthetic leverage, bypassing standard debt costs that they don't want to, be taking on. Again, because they have, if they borrow, that means they have to kind of make more to offset the borrowing cost, expense ratio, the bid-ask spread price, all of that stuff. All of it matters. All right, so the death trap door number 2 is the gamma trap, right? So here is where I think turbo boosters does become a death trap. All right, this is one of the things that does worry me. So combining synthetic leverage with short calls create a dangerous asymmetry, right? The first one is the downside trap. So because I sell index puts to fund the leverage, if the market crashes, these put quickly gain negative delta, meaning your pain accelerates exactly as the market drops further. But you do have to understand it's a 1.5x, right? However, the second part to this is the upside convexity capping. What that means is conversely, when the market rebounds violently, right, with the V-shaped recovery, the out-of-the-money calls I sold act as a hard ceiling. This is the cap. For almost all cover calls, this is the cap, right? This strips my portfolio of its natural positive convexity, right? So I cap my slingshot recovery. This is the warning here that I have to keep and think about if I really want to add this to my portfolio, is that I capture the downside faster than the upside, right? So it is inherently very, very fragile. All right, let's look at the turbo specs underneath the hood. Okay, so basically inception date, freaking new. It is so new. Assets under management, very, very low. Of course, we want to be keeping track of this, and I will be keeping track of this as it's on my watch list, and if I want to buy it, all right, how much has it grown, right? Follow the money, follow smart money. Okay, the shares quite low, expense ratio very high at 0.98. Initial dividends or distributions pretty good, pretty solid. They're holding up to their yield, right? All right, so what does this chart say, and what do I ask of it? Is 0.98% expense ratio expensive? Yes, but it does reflect immense operational complexity. So I do understand that part. It is a highly competitive when viewed as a financing cost compared to traditional retail margin borrowing, and pretty fair, pretty baseline if you want to compare it to other leverage plays. Okay. The objection here is, yes, while 0.98% fuel side, it is required fuel cost for the turbo engine. No one's going to put this out when, for such a low price. So I understand that part. All right, turbo charging my risk. Let's look at the Qs, right? The XQQI concentration. So you can see it's basically straight up all tech, right? Well, a little bit of retail and other sectors. So the 1.5x structural leverage acts as an intense multiplier on underlying sector weights, right? So the Q right here operates as a hyper concentrated vehicle, while roughly 60% of its massive leverage exposure is dedicated solely to big tech, right? The reality is when you're buying this, I'm not diversifying. I am massively concentrating my bets on tech. Okay, top holdings overlap. Again, I said it's not diversified. So if I'm holding SPI, QQI, and add XSPI, I am not diversifying, right? I'm just adding an acting booster of 1.5x volatility multiplier on the exact same underlying macroeconomic exposures. That's what I'm doing here, right? Both ETFs share deep concentration, pretty much the same type of beta, except leverage does have a higher range of volatility, right? I'm doing it on the index, and if you're buying the Qs, you're doing it basically the bet on the big tech. All right, death trap door number 3 is the liquidity shocks. So if 20% of the fund seeks redemption during a flash crash, right, the physical stock offer deep liquidity. But the multi-leg here is the synthetic options must be unwound cleanly by authorized participants. Of course, then if there is none or it's very low, then that's going to cause a lot of issues. So basically, when the VIX gets very extreme, we don't know. It could get very extreme with the current events that are happening. We don't know, right? The bid-ask spreads on these derivatives could widen dramatically, right? So the slippage cost here could be anywhere from 1%, 3%, 4%. We don't know. This is where the 0.98 fee does not account for this crisis execution slippage, right? Panic selling could surge and create invisible cost that eats my principal alive. And you won't really see it until like it's a little too late because it is delayed. All right, crash testing the turbo boosters, right? These are my scenarios. These are my what ifs. I like doing these because I want to play out all type of scenario, okay? Because XSPI and XQQI lack long-term empirical trading data, I have to mathematically, extrapolate the 1.5x leverage multiplied against historical shock events. So looking at this, looking at the verdict here, my verdict, in adverse scenarios, these amplify capital destruction faster than yields can compensate. Okay? If you own this already, just understand my scenario, my outcome is that your capital destruction pretty much erodes a lot faster than you can get compensated and kind of make that return. So just understand that, it is a huge risk. I am going to give it a full year before I really want to add into this. I'm willing to wait a full year. Hopefully I can hold myself till next February. Okay, turbo versus the rest of the world. So let's put it up against T alpha, TSYX, and TDAX, right? So they utilize a fund to fund structure, applying a 1.3 daily resetting leverage and a writing 0-day time expiration, right? The daily options. So this extracts maximum data premium but suffers immense volatility decay in choppy markets. NEOS is structurally superior for holding through standard turbulence. That is just my opinion. That's how I see it. We can talk about this in the comment section. We can go back and forth. It's not an attack on T alpha. As great as they are, I do think NEOS is structurally superior for the standard turbulence. All right. T alpha in choppy markets, I would say they hold worse. Let's compare that to pure leverage of SSO and QLD. So it's very crucial that we do not confuse XQQI with pure leverage ETFs, because QLD offers an uncapped 2x upside explicitly designed for short-term compounding. For those who own it, let me know how you're doing with it. All right, XQQI is leverage but capped, right? So I trade absolute upside convexity for immediate cash flow, right? That's the huge difference here. In a mega bull run, XQQI will vastly underperform QLD. Okay, the rebuttal to all of this is that NEOS minimize intraday friction, but I give up uncapped bull market runs. You have to understand. I have to understand these differences when I'm buying a NEOS boosted ETF. All right, let's look at the 14.5 death trap hurdle. What do I mean by this? Well, looking at a 20% distribution yield, it does not mean a 20% economic return, okay? So to avoid NAV erosion, the underlying index must generate a CAGR of roughly 14 to 15% continuously, okay? Looking at 50% index CAGR multiplied by 1.5x leverage gives you a 22.5% gross. Now let's add everything that you typically don't, have in mind. A lot of people don't mention this. So take that 22.5% minus your expense ratio, right? Your fees minus the 1.5% drag equals roughly a 20% payout. If the market doesn't grow 15%, they are cannibalizing your principal to pay you. I'm going to say that again, okay? If the market doesn't grow by at least 15%, it is NAV erosion. This is the hurdle here. Yield greater than economic returns equal principal conversion. On top of possibly them not giving you 100% ROC, you're paying taxes, you're paying the expense ratio, and you're losing on your NAV. That's a loss on all three fronts. So a lot of people don't keep this in mind. So just keep this in mind. This is why I haven't pulled the trigger on this yet. All right, the slow death trap, right? Stagnation bleed, right? So everyone models crashes, but the hidden Achilles heel is the boring pain, okay? Let's project a modest 6% annual return for the NASDAQ for the next 5 years. What does that mean? Well, XQQI gross lever return is about 9%, right? We do it 6% times 1.5. The net return, right, after fees and friction is about 6.5. Target distribution is about 20%. Your annual shortfall with your NAV bleed, right? NAV erosion is 13.5. So $100 NAV becomes 86, becomes 74, becomes 64, becomes 55, becomes 48 within 5 years. My principal is cut in half without a single market crash. Okay, this is reality that a lot of people do not talk about. Slow erosion destroys my principal over time. What is the point of this? It's not even boosting anything. And they're just trying to give me a boost. Well, it's not boosting anything, right? All right, the retiree death trap. Please don't spend it. Those who have bought it and already, retired. I'm gonna say these are three things you do have to look out for. The withdrawal trap, meaning if you spend your 20% yield to pay bills while the market is crashing, you lock in your losses permanently, right? The income acts as a dangerous mirage. It's fake. It's fugazi. It's an illusion. Second is the math is very unforgiving here, right? If you do not reinvest the cash at the bottom of the crash, your portfolio will never fully recover. The math simply won't allow it to bounce back. It is pure math here, not me. It's the formula, it's the math behind it. And third is the panic selling. If you're retired already and you do see a 40% drop, which causes you to panic sell, right? When everyone does rush for the exit, the fund is forced to sell assets, suffering even more damage, right? So this is the true fear I'm giving to you. However you want to take it, withdrawing cash during a drawdown guarantees that you have permanent capital impairment. Okay, steering the turbo rocket. So how actively does NEO adjust the synthetic leverage during massive drawdowns, right? So if the market falls 40%, the 1.5x exposure applies to a shrinking capital base. So this is just a guess. I'm thinking, hey, if they go down this route of strict rebalancing, which means if management strictly rebalance to maintain the 1.5x target during a crash, then they are forced to sell my physical assets at the bottom and locking in permanent losses. What if they choose a different route, right? The passive drift. So if they allow the leverage ratio to drift down passively, then the fund loses the mathematical horsepower needed to catch the eventual rebound, right? That V-shaped recovery. And what about the burden here, right? This is where you, if I own it, right? I have to actively track coverage ratios, NAV trends, ROC percentages, and the VIX monthly, right? So if premium coverage falls below 80%, then erosion risk spikes immediately. This is where you have to kind of keep track. This is definitely not a passive set and forget allocation like their other ETFs. I would say is more set and forget. Okay. So the Holy Grail environment, we have to look at the VIX regimes here, right? So a 20% yield is highly conditional, dependent on the prevailing VIX. And this is my guess. This is just my guess. And the low VIX, which is under 15 or under, option premiums compress, right? It kind of gets lower, crashes, right? So to hit the distribution target, managers must write options closer to the money or at the money, and that chokes off the upside participation and apply severe stress to my NAV. What about moderate, right? Where 18 to 25. I think for this boosted ETF, this is the Holy Grail zone, right? Premiums are rich enough to fund the distribution using a better far out the money strikes, right? Allowing the 1.5x leverage to capture a meaningful equity growth, right? So this is where you get nice payouts plus the NAV grows a little bit. But what if we are in an extreme VIX, right? When it shoots up to 30 plus, 40 plus, right? This could lead to delta destruction from the leverage completely overwhelming itself with the massive income generation, which could result in catastrophic NAV loss for my portfolio. So understand your strategy here is that volatility regime matters more than the market direction for these ETF. Okay, volatility matters more than where the market is going, up or down. Volatility is the name of the game for these boosted ETFs. Okay, so again, this is where I think these turbo boosters belong. Right, these instruments, please, are not bond substitute. In my actual risk stack, where I kind of play it out here, this is my guess, they sit closer to leverage equity derivatives than true income securities. Okay, so from top to bottom, right? At the top we have 1.2x leverage ETFs, right? Highest directional volatility, and then right beneath that, not 1.2x, right? So number one is, I would say the highest risk, and then what comes before that is turbo boosters, right? XSPI, XQQI. These are the leverage equity derivatives with capped upside. And then we have the broad equity index, right? The SPY, QQI, standard market beta exposure. Then number four is where most of us hold the unlevered cover call. This is where we say, okay, these are the high yields, but pretty safe, moderate, the gold standard, right? SPY. Reduced beta with standard income generation. And then five is, depending on how you pick it, I would say it's a little bit safer, right? The preferred shares and the REITs, right? These are the, the realty income, main, right? These are your top tier BDCs. These are pretty much your dividend growth ETFs. And then I would say the safest is, of course, your investment grade bonds, right? I don't think, especially us millennials and possibly the Gen Zs, right? We're not investing in bonds for the most part. I don't think so. We're not getting anywhere with bonds, right? Typically, those for the older, and they have a lot more money, and they can just throw into bonds. They don't have to worry. So this is my placement. I'm going to say treat this as a leverage equity derivative, not a safe income generator. This is my thoughts so far about it. I could be wrong. So the question is, Holy Grail or Death Trap? I asked myself this. Does it belong in my portfolio? Yes, but only as a small, very small tactical satellite. 5 to 10% max. Max. 10% is pushing it for me to help supercharge my cash flow, but it's definitely not a core holding. I only use this if I have absolute conviction in a continuous low volatility bull market. So I'm giving this a full year. I'm watching it and keeping a good eye on this. If it drops significantly due to market conditions, I might go ahead and add it to it. But at these prices, I'm just gonna wait. Then I asked myself again, but what if I want a set and forget long-term hold? Then it's absolutely not, right? This is a terrible 10-year buy and hold, right? The 1.5x structural leverage, capped upside, and finite tax shield will guarantee long-term NAV erosion and flat markets, right? So if I spend the yield over the long run, I am cannibalizing my own principal. So again, do I want to be facing these headaches, right? If I want a kind of semi-set and forget, then I'm going to say no, because I want to hold this for long term, right? So financial gravity does remain unbroken for this, right? These are powerful tactical tools, not a permanent foundation, okay? Coming to a conclusion here when I ask myself this is that, yes, high reward demands extreme situational awareness, right? Size, position smartly, okay? I'm all about more semi set and forget buy and hold. So this might not be a good core position for me because I don't see myself as a tactical trader. I don't like to buy and then sell within a month, 3 months, 6 months. I like to buy and keep it. That's what I'm all about too, right? I don't got time for. I'm too busy, right? I want to be relaxing on the beach. I don't have time to be looking at the markets 24/7. All right, so that's the end of it. That was my quick deep dive and how I personally feel about it. If you got anything out of it, if you feel the same way, if you're new and you thought you're about buying it, and I opened up to some new information about it, give you some new deeper thoughts, help the channel out, subscribe, comment, like. And what do you think about these turbo boosters, right? Are you chasing that 20% yield from NEOS, right? You think it's the Holy Grail yield, or are you staying safe away from the death trap with your core holdings, right? So I really want to know, because I eventually want to break out of the 50%, and I do want to add a solid 20%er. Drop a comment below and let me know your strategy, and help me out. Make sure to smash that like button and subscribe for more deep dives into these insane ETFs that are constantly coming out. Help me beat the algorithm. Help the channel grow. See you in the next video. Thanks for watching. You guys are the best. I really mean that. Thank you. Thanks for watching. Catch you guys on the next.